Hey, welcome to the Mortgage Minute for this week. Looking around for articles, I found this one that talked about the Fed. That's the U.S. version of the Bank of Canada. A Fed official warned central banks should act prudently. The bottom line messaging in this article was that one of the Fed officials was basically suggesting that the central bank in the United States should be very cautious about raising rates further because any further raising of rates could stall the economy. That translates into the fact that the Bank of Canada here in Canada is not likely to raise rates again. So again, we're going to be looking to lean towards variable rate mortgages. In the meantime, here's an interesting article by Rob Carrick saying housing policy should reconsider 30-year amortizations for millennials. It goes on to say that, this is interesting. A recent study says millennials will make up the largest group of eligible voters in the upcoming elections, and housing affordability is going to be big on their list. So the millennials who do not own housing are going to be large voters in the next upcoming election. Look for government to push for affordable housing, rules and agendas in the upcoming elections, be it provincial or federal, which is interesting. And we also saw that OSFI, the Office of Superintendent of Financial Institutions, wow, that's a mouthful, growing pressure on them to basically get rid of the stress test, but you know what they're saying? No, we're going to keep it. They're not bowing to pressure. There was some talk about maybe they would bow to that pressure. So what are we looking at when we look at all this? The stress test is not going away any day soon. We're seeing that the millennials are looking for housing affordability. We're seeing that Ottawa is going to be very cautious about relaxing any mortgage rules. In the meantime, what we're seeing is the banks are trying to find ways to get their money out the door. They're basically kind of handcuffed by the Ottawa rules, but at the same time, banks need to make money. I know, we all feel sorry for them. But the reality is they're going to start to look for ways to get money out the door, and one of the ways is in the spring market. So as the spring market approaches, we start to look for some rate specials. So I'm going to predict once again, look for rate wars as a kickoff to the spring market. This is mid-February or late February as you're getting this video, while March is just around the corner, and that's typically when we start to see that. In the meantime, what should you do? Should you take a fixed rate or a variable? Where are rates going? Saw an article here, basically 68% of all Canadians choose fixed rate mortgages. Only 27% are in variable rates. But here's a chart. If you go and watch bond yields, you can see where bond yields are going. See this free fall here? That shows you that bond yields have dropped down. As of today, February 19th, it is 1.8. 1.8% is the bond yield. Now, I typically take 1.7, add that to the bond yield, you get your 5-year fixed rate mortgage, which should settle in around 3.5%. What this tells me is the banks have a 1.7% buffer, cushion, profit margin, if you will, and that says they've built up a bit of a war chest over the last few months. Now you'll see it here again, there was quite a drop in the bond yields. So with that war chest, look for them to go into the spring market, dip into that war chest, and start having rate specials. Prime -1 on variable rates. It's going to be a good deal, something everybody should take a look at. In the meantime, shifting gears here as we near the end. We're looking at the end of RRSP season. This was not an article, but advertisement that I thought was just brilliant. It says, CNBC said nothing worked for investors this year. Fake news. Well, this was actually an advertisement by Romspin promoting that that's not true. It's not that everything didn't work, it's that the public markets didn't work. And if you have mutual funds or public market money in the stocks and bonds, you noticed what your returns said at the end of at the end of December, you might have been not really happy when you opened up your statements in January. In the meantime, I just want to remind people that we do have some private equity alternatives. I always recommend a percentage of your investment should be put in private equity. And as the advertisement there for Robinson suggests, Centurion REIT produced 9.85% return last year, and AP Capital had a 7% return. So again, if you're not happy with the returns you're seeing in your stocks and bonds, you do have options. Send me an email. We can review and analyze your RSP investment options or your whole portfolio, whether that's real estate, stocks, bonds, private equity, or if you just want to analyze the complete thing as part of a 5-year plan or a gap analysis, Happy to do that. Ladies and gentlemen, that's the Mortgage Minute for this week. We'll talk to you soon. Send me an email, peter@peterkinch.com, and happy to review your options. Thanks a lot.